How you doing, everybody? Welcome to Stock Markets with Bruce. It's your Uncle Bruce here for a Monday morning. How was your weekend? Welcome one, welcome all worldwide to this channel where we talk about the stock markets in plain English, and we got some plain English in to do today. There's a lot to talk about, lots to try to figure out, speculate on and wonder about, try to explain the unexplainable, whatever it might be. But the news this morning is percolating here about a hedge fund. It seemed that on Friday, a hedge fund, which is apparently called ARCHEGOS, something like that, ARCHEGOS. This hedge fund got a margin call, and they had a number of their bankers tell them, you've got overexposure in the market. We need you to unload stock. We want you to cover your exposure on stock. And I'm going to guess that this didn't happen all at the same time Friday morning. I have a suspicion that all week long that this was building, and that this was a situation where a hedge fund had borrowed money from a number of financial institutions that were willing to lend the entity money. Let's not pass this over too much. Banks were very eager to lend money to this group of this particular group of people inside this particular hedge fund. They deal with a number of brokerage firms around the world. They have accounts all over the place. They have assets spread out globally rather than just in one office, in one city, in one place. And it's also possible that they were leveraging their portfolio more than one time. And this is where it gets kind of interesting. And it looks to me like what was going on was this company was able somehow to borrow money against money that they had already borrowed for assets they'd already borrowed money to buy. So whether one bank lent them, $500 million on top of the billion they had already, and then they were able to borrow more money on the now $1.5 billion of assets under administration, and then they were able to borrow $1 billion against the $3 billion under administration, and another $1 billion under the $5 billion. This is the leverage factor. And if you have a crafty enough group of people desperate enough to try to make a big score, and remember, hedge fund managers and operators of hedge funds usually work on what we call a 220 arrangement. All right, they'll work a deal where all the money they manage, they get 2% fees of the value of the portfolio. Whether it goes up or down is irrelevant, and it's charged monthly on a 1/12 basis. You take 2% divided by 12, and every month you charge 1/12 of 2% on the value of the fund. So the more your fund is carrying, the more fees you can generate. That's one. Two, 20% of profits. So if your fund at the end of the month made $1 billion in profits, 200 million in profit sharing goes to the fund manager. And this might be done on a quarterly basis, which is why this Wednesday is so important, or done on a monthly basis, however these funds work the deal. Every hedge fund has its own separate arrangement with its own hedge fund investors. And this is a private arrangement. These are private contracts. They're not for public disclosure. No filing is needed to be done at the SEC. There's no reporting to any stock exchange. There's no reporting to different bankers. This is just a private arrangement between investors and administrators of a privately run hedge fund. And some funds are based in China, some are based in Japan, some are based in Vietnam, some are based in Switzerland, some are based in the Cayman Islands, some are based in Manhattan. They're all over the world. And some are very much running in tax-free jurisdictions for obvious reasons, that whatever profits are made are not taxed. And as long as those funds stay offshore and other offshore entities, no taxes. There's a huge incentive for hedge fund managers to make money and grow their assets under administration. So coming back to these guys, it's entirely possible that these individuals and these groups have been leveraging their mutual fund, their hedge fund, for years. months and years. And banks are so desperate to do business because, as you may have noticed lately, I've been talking about how certain companies can raise money from bond offerings for zero interest. How do banks make money? How's that going to happen? If you're a bank and you lend money to people, and corporations can go to the bond market and borrow money for zero interest, where's your upside coming from? Well, your upside is coming from alternative places to lend out money. And if you've got an eager borrower, like a hedge fund, that is showing you a statement that you believe is genuine that says, we manage $8 billion in assets, we're looking for $1 billion loan. The bank's going to go, hey, it's only 12% of the fund's value. Yeah, let these guys borrow $1 billion. And in some cases, they probably started off with $300-400 million at a time, and then they just slowly added to it. They added 100 million here. The bank would call them up. So you need any more money? Well, yeah, we'll borrow another 200 million. We'll just add it to your line of credit. Go ahead and write checks. And so bit by bit, from institution after institution after institution, this fund, and perhaps dozens or hundreds of others, and that's the speculation I want to get you to understand here. A zillion of these funds have been borrowing tens of billions of dollars for leverage to buy and sell stock in the open market, buy and sell bonds, buy and sell credit default swaps, or whatever else they're into, what real estate, it's all leveraged, leverage. And if your bank isn't an aggressive lender, you don't lend out money. You don't lend out money, you don't bring in interest. You don't bring in interest, you don't pay the bills. And then you, as a loans officer, corporate loans officer, might find yourself out of a job with a guy who's more eager to lend or able to find business to lend to. And so the thinking at the banks has been, well, hedge funds are the perfect guys to lend money to. These guys are liquid. They're into the markets. They can liquidate out anytime they want. If we tell one hedge fund we need $100 million down on your line of credit, a couple of days later, $100 million, no problem. We're managing billions. We'll make a few adjustments. No big whoop. So it sounds great, looks great, feels great, is great, except when it's not great. And it could well have been that a single banker in the chain of all the banks that this company was using for loans uncovered an anomaly. And it could have well been that, yeah, you guys are running 10 billion or 20 billion under admin. Yeah. But my little sources are telling me you guys are exposed to a bunch of banks, to a whole bunch more money than we thought at this bank. And so this bank is going to call in, we're going to call in $500 million of your exposure. In other words, you owe us, you borrowed $500 million, we want it all back, and we're going to give you 72 hours to cough it up. All depends on the covenant, the deal that was made between lender and borrower. And if the bank has the right to call the money within 24 or 48, 72 or whatever hours, that's the deal. And so the hedge fund has to come up with cash. Now, one way to do it is you pick up the phone to Credit Suisse or to Deutsche Bank or whoever your other bankers are and say, yeah, we want another 100 billion on that loan. Oh yeah, okay, go ahead. And then we want 100 billion from these guys, 50 billion from those, and they're cobblestoning 500 billion together without selling a single stock. And they're just bringing money in, and they're transferring 500 million over to this banker, and the banker's paid off, and now all is well, as long as the banker doesn't talk. If the banker shares his or her concerns with another institution, or the mere fact that a bank is doing some due diligence that's being picked up on by other institutions, they're going to wonder why so-and-so bank doing all this due diligence on this blah 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 hedge fund. What's the big deal? I thought those guys are fine, or they owe us $1 billion. They've never missed a payment. They always pay their interest payments. We never have a problem with these guys. Why is so-and-so? The rumor has it that so-and-so pulled their $500 million loan with these guys. What's going on? And bankers are fidgety that way. They have feelers out everywhere, and they've got the pulse of the market right under their fingertips. They're very, very sensitive, and they really feel the slightest shift in anything. 1/100th of a percentage point move on the 10-year U.S. bond, like we saw in the last month or so, 1/10 of 1% move in a 10-year U.S. note, that can upset the apple cart by 600 points on the Dow Jones Industrial Average in an hour. I mean, these guys are finicky. So to hide and try to ignore this kind of a movement, tough to do. And so institution number 2 calls up and says, yeah, listen, we gotta take you from $1 billion down to 500 million over the next 3 days or 5 days. And all of a sudden these calls come in, and this entity is all of a sudden going, we have too many holes in the dike, water's leaking in, and we haven't got enough fingers to plug all these holes anymore. We got to start liquidating. We can't just borrow our way out of this problem. We don't have enough lenders calling us saying, hey, you want another billion, want another $500 million? We have to literally start liquidating stock. And so that process begins. And like I've told you before, many a time, I've mentioned this to you all. Why is it that GameStop shares sometimes will trade up $15 in a day, $20 a share? They'll be up $20 a share. And then within 30 minutes, that stock will drop $15 in 30 minutes on 500,000 shares of selling, because someone who's short wants to keep that stock price down so that they don't look as bad as they've been looking with that stock moving up. And if they can drive that market down by being able to borrow 500,000 shares at a very low interest cost, they'll literally borrow stock if they can get it at a low rate, and then hit the market with that stock and drive the market down 10 or 20 or $30, or they'll do it 5 minutes at a time, every hour or every half hour. They'll just wait every 30 minutes, hit the market again, and make your GameStop go down, a little come up, it'll go down, it'll come up a little bit, go down. It just looks terrible. If you're short, that's what you want to do. And if you're able to borrow, that's what you'll do. And then you're carrying a larger position, a larger short position, and all is well, as long as the game can continue. However, when this outfit over here on Friday, the word came out that they had to sell upwards of $10 billion of stock to cover margin calls that were coming in. Again, bankers calling the company saying, you're overextended, we want our dough. These guys now had to sell stock in a hurry. And as I was saying earlier with GameStop, certain sellers in GameStop are selling at any price they can get as fast as they get because they want the stock to go down and make it look awful. Others who want to sell GameStop that actually need to raise money, not to drive the market down, but to raise cash, they will very carefully sell GameStop or IBM or a hedge fund or an ETF or any asset they have. They will slowly piece it off as to not raise any suspicions with any other institutions, bankers, hedge funds, floor traders. They're trying to just calmly transact business as if nothing is the matter. Again, thank you all of you for being here and asking these questions. I appreciate it.